Good morning, good afternoon, good evening, and good night to all of my irresistible money magnets. Today is Money Monday, so we are going to talk money. Last week we talked about Roths and money market accounts. The week before that we talked about CDs and savings accounts. This week we are going to talk about 401ks and index insurance policies. Now, 401k is a retirement savings tool that allows employees to contribute a portion of their paycheck into an investment account every time they get paid. Employers usually match a part or all of the contribution that the employees make, meaning if you decide to put up 4% of your check every paycheck, your employer will match that or maybe even go above and beyond, just depends on your employer. With the traditional 401k, the contribution is made pre-tax, meaning that's before payroll tax, before your federal withholdings or state withholdings if you have withholdings coming out. Some people go exempt. I don't recommend it. But anyway, it's before all of that. Now, you as the employee or anyone participating in a 401k plan has a number of choices of how those contributions are invested. If you have the option to participate, I recommend that you do it and you try to invest at least up until the amount that your employer will match. So, say for example, if your employer is willing to match your contributions, say up to 4.5%, right? So you're getting 4.5% of whatever your check is deducted to go to your 401k, and then your employer is also matching that amount. So basically, you're doubling your money. So instead of it just being 4.5%, it's actually 9% that's being contributed to your 401k plan every time you get a check. Now, usually because this is pre-tax, up to a certain percentage, you really won't even see a dip in your take-home pay because this is pre-tax. So it's coming out off top, and then what's left is being taxed. And sometimes if you get to the right percentage, it'll be a wash. So for example, I know of someone who does 4% pre-tax, and that 4%, like after all was said and done, there was really only a difference of about $30 of take home that was affected. Mind you, more than $30 was being taken out off top, but because of how everything works out with readjusting the numbers and things like that, it really only was like a $30 dip in take home pay. And when you consider the long term benefits of the 401k and you investing, it's not a big deal. Especially if you're working on that budget, like we said, just charge that to the budget. You know what I mean? Reallocate some stuff. Um, when you opt into a 401k plan, usually there's a plan administrator, and then two, usually there is an advisor who will be there to give you information with regards to the different ways that you can invest that money. They won't tell you exactly how to do it, but they're going to give you information so that you can do your own due diligence, do your own research, and then invest in a way that you see fit for you, being based on your age, based on what type of risk you want to take, whether you want to be moderate or you want to be high risk, you know what I mean? So they will point you in the right direction, but they won't necessarily tell you which way to go. Got me? Now, this next thing that we're going to talk about is index universal insurance policies, also known as cash value insurance policies. I'm talking about this particular tool because a good friend of mine, who is a doctor by day and a fashionista all day long, wanted to know about it. This is one of the few products that I particularly did not have when I was asked about it. So I had to do my due diligence, and because I network and I'm lightweight connected, I know a CEO who does have these types of policies, and we've talked about it before in the past. So I was like, all right, I got his input, then I did my own research, and now the kid has her own index insurance policy. But anyway, um, basically what I found is from now on I'm gonna say IUL just to keep it short. The IUL insurance policy basically helps build wealth while also making sure there's something left for the people that you love when you happen to pass away. Basically, the premium payments that you pay for this insurance policy is split in 3 different ways. Part of that payment goes to the policy itself. Part of the payment goes to cover fees for having that particular type of policy. And then the rest is cash, which is set to the side, which kind of builds equity. And we'll go into that a little bit more. The way you establish to have an excess cash in this particular policy is that you're basically overfunding the policy annually. The cash portion of the policy earns interest, which is based off the market, as in the stock market. The amount that you can overfund this particular policy depends on what type of policy you choose. So if you choose like a $500,000 policy, then of course they're not going to let you fund it as much as if you chose $1 million policy. You get what I'm saying? So the amount that you can overfund the policy is going to be based on the type of policy that you choose. Now, just to be honest and keep it raw and uncut, this particular policy is primarily geared towards those who have a large amount to invest up front. Not saying that would preclude anyone, because if you do your due diligence, you can find one that's going to let you do like a monthly payment, but you have to do the research. But like I said, individuals who have a little bit more already put away, save and set aside to initially fund the policy, that's kind of who it's for. But it in no way will limit you if you do your research and find a company, because even with my Google search, I found some places that let you do a monthly instead of an annual, all up front. You get what I'm saying? However, keep in mind that with that monthly, you also still want to try to be putting enough towards so that you are starting to build up that cash value of the policy and equity. This, as I said before, the cash portion of this particular insurance policy, the interest you earned is subject to the stock market. So that is the only volatility you would experience. And what I mean by volatility is that sometimes the market's going to be super high. So you'll get like 12% interest on your money. That's just an example. That's not hard and fast. It's just an example, right? So if it's up, then it's up. You're getting like 12. But then when the market dips, say it goes to like 1%, that's all you're getting for that period of time while the market is at 1%. However, you still have cash in there. It's not like when you buy like some, let's say, tech company stock, and one day it's up $100 per share, right? Next week it's down $20 per share. You see how you lost the 80? With this cash policy, you're not losing that 80. All you're losing is the amount of interest that your money will earn. Now, the gains on this particular, the gains or the increases that the cash portion of the policy earns technically should be taxed. If it was set up a different way, the gains that you earn off that money would be taxed. But because of the way this policy is set up, the capital gains are tax-free as long as you maintain the policy, right? If for whatever reason it lapses, then those gains become taxable, and then you have to pay taxes on that. Some of the other benefits of this particular policy is that there is no what they call RMDs, or required minimum distributions. And what those are is if you have a 401k or a Roth IRA, when you get a certain age, you're required to take distributions from that particular account, whether you need it or not. And then once you take a distribution, guess what? You're taxed on it. With this particular policy, you're not required to take a distribution from it, because what happens is your cash that's in the account gains equity, and it essentially, in order to, you know what, put a pin in that because I'm going too far. I'm gonna circle back on that. Some of the other benefits to this cash policy, it will not affect, say for example, Social Security is still there when you retire, right? It's not going to affect that money. So when you start pulling that Social Security and you decide to borrow against the cash equity in this policy, it's not going to affect it, because black and white, you're borrowing against your own money. You know what I mean? You're accessing it in advance than when you should, so it's not affecting this Social Security money that you're getting over here. It's like two different things. And now back to what I had just put a pin in. The way you access the equity in this particular, on the cash portion of this policy, is you borrow against it. Just like if you own a home and then when you bought it, it only cost you $100,000, but 5, 10 years later, it's worth $300,000. That means you have $200,000 worth of equity that you can access. And the way you do that is you refinance and you pull the equity out, right? Same concept with this particular tool. Your cash, your policy has cash in it because you overfunded it, and that cash has also earned some interest in equity. You pull that out, and when you pull it out, you do pay it back with interest, but you're paying yourself back. You get what I'm saying? You're paying a money game with your own money, essentially. The only thing is, say for example, you do it and then you happen to pass away. If that loan that you had borrowed against your own money isn't paid off, then when it's time to cash out the policy to the people to whoever your beneficiary is, that is coming out off top. Yeah. Now, one of the other some different things that you can also do with this policy is that you can have some different add-ons, which are also known as riders in the business. One particular rider that I know some of my clients have, are long-term care cost riders. And what that means is if for whatever reason you have to go into a nursing home and have to be cared for, then this particular policy, if you have the add-on, if you have the rider for long-term care costs, they will pay out to the nursing home for your stay. And when I say like these nursing homes are not like no county, no state rent type things. They are borderline baby spas. You know what I'm saying? They have salons in them, pet groomers, dry cleaners. Like it's legit like a nice little spa. And nursing homes like that require money, a lot of money. And so you can add on a rider to this particular policy and it'll cover the cost for that if you do it right, if you set for the right amount of money. One other thing that I wanted to mention, some of the cons, or not necessarily cons, but the details. The devil is always in the details, right? So with this particular policy, you cannot let this policy lapse. You let it lapse, then you'll be subject to paying tax on those gains if you have them. 2, you let it lapse, you kind of forfeit a lot of what you put into it. So with that being said, get a policy with a premium that you can afford in the good times and in the not so good times. So when you set your annual premium, or if you go the monthly route, think about, okay, would I be able to afford this when there's another economic downturn, like when the housing market crashed back in 2008, or like right now when some people had to experience different changes in their income because of COVID. Like, so keep those things in mind when you're looking at a policy. Like, don't set some pie in the sky policy amount because like you living high on a hog right now. You know what I'm saying? Like, find something in between your lows and your highs and get right there and base the amount of money you want to pay for your policy on that. Another thing that you need to pay attention to is the maximum return amount set by the insurance companies. They're never gonna, well, I won't say never, but hardly will you find an insurance company that's gonna give you 100% return on your capital. You know what I mean? But sometimes they'll cap it at like 25 or 75. So just pay attention to what the maximum return that they will allow on the cash side of your policy. As I said before, the interest rate will vary. So sometimes you may get, when the market is really good, you may get something up to as high as 12-15% interest on your money. That's kind of high, but you know what I mean. And then in other instances, maybe when COVID or the whole housing bubble bursts again, then you'll be down to 1% or 0.05%. So that's something to keep in mind, but it's still going to be more than what you had at the end of the day. Also, be mindful of the different fees that whatever insurance company you decide to go with charges for handling or underwriting this policy for you. So you want to keep that in mind. I know that was fast. I got kind of winded, but that's all I got for now. I really do hope it was helpful. For the month of November, we are going to go over credit. So if you have time, you have a moment, go to www.freeannualcreditreport.com and pull your credit report from all three of the major credit reporting agencies. Some of you may have Credit Karma and different things like that, or your credit union may just tell you what your credit score is daily, monthly, however it goes. But those all in one way or another get their information from the major three credit houses. So again, if you haven't done it for the year of 2021, go to www.freeannualcreditreport.com, pull down all three of your credit reports so that you can see what's on there, the good, the bad, the ugly, the indifferent, so that you have all the information. As always, knowledge is power. That's what the people say. That's it for now. One last thing, don't forget, be good or be good at it. All my areas are still money magnets.